to the Q2 and H1 FY2023-24 earnings conference call of PNB Housing Finance Limited. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Deepika Gupta Padhi, Head, Investor Relations and Treasury. Thank you, and over to you, ma'am.
Thank you, Darwin. Good evening and welcome, everyone. We are here to discuss PNB Housing Finance Q2 and H1 FY23-24 results. You must have seen our business and financial numbers in the presentation and the press release shared with the Indian stock exchanges and is also available on our website. With me, we have our management team over here, led by Mr. Girish Kousgi, our Managing Director and CEO. We'll begin this call with the performance update by the Managing Director and CEO, followed by an interactive Q&A session. Please note, this call may contain forward-looking statements which exemplify our judgment and future expectations concerning the development of our business. These forward-looking statements involve risks and uncertainties that may cause actual developments and results to differ materially from our expectations. PNB Housing Finance undertakes no obligation to publicly revise any forward-looking statement to reflect future events or circumstances. A detailed disclaimer is on slide 27 of the investor presentation. With that, I will now hand over the call to Mr. Girish Kousgi. Over to you, sir.
Good evening and welcome to all the investors to Q2 FY24 earnings call. Second quarter was very eventful. We have done well on all the parameters: disbursement, growth, and margins, asset quality, and profitability. If I have to talk about disbursement, Q2 we disbursed 4,165 crores. This compared to last year, Q2 was 3,528, registering a growth of 18% YOY. And on sequentially, we have grown by 13.6% on disbursement. In affordable, we are seeing very good traction. We just started this business about 8 months back, and Q1 we had done 228 crores, and Q2 we have done.
Ladies and gentlemen, the line for the management seems to have disconnected.
Affordable, and we are very confident of crossing 1,000 crores in the short term. On login and sanctions, the growth is about 31% YOY. So we have seen overall growth not just in disbursement but also on login and sanction. Market is quite robust. We are seeing very good traction. Our loan book guidance of 17% stands. So H2 will normally be better compared to H1, and Q3 and Q4 will be very good for the company, and we'll be able to maintain 17 to 18% of the growth. On the loan book, overall loan book, Q2 the book was 60,852 crores. This compared to last year, Q2 was 57,832. On a YOY, the growth is 5.2%, and sequentially it is 0.8%. So we had resolved one large NPA account in the corporate, and therefore the book has degrown. The corporate book has been degrowing. Talking about the corporate book, the book as of September is 2,381, which was 5,700 crores last year Q2, which is a degrowth of 58%, and this is as per plan because we had taken a call to degrow the book, work on resolution, bring down the NPA, and then at the right time restart corporate business. The restart of corporate business is well within our plan. So very shortly we are going to restart in a different form altogether, focusing on select projects, select locations, a ticket size of 150 to 200 crores.
You may go ahead, sir.
Okay. I'm not very sure whether I was heard. I spoke about retail disbursement, sanctions, logins. Okay, now let me continue. On the corporate, we have a plan to restart business that we will start in few quarters. We'll be doing in a totally different format, focusing only on construction finance. We'll be pick and choosy on developers, locations, projects. The ticket size is going to be about 150 crores. And this is a plan, and we will restart. The plan was to degrow the book. At one point in time, the book was 18,000 crores. We have degrown. As of September, the book is 2,381 crores. Same number last year, Q2 was 5,700 crores. So there is a book degrowth of 58% in last 1 year, and sequentially the degrowth is about 30%. Retail loan asset grew by 12% YOY to 58,471 crores on September 2023. With H2 FY24 expect to perform better than H1, we are on track for, as mentioned earlier, we are on track for 17 to 18% growth on book. Core retail book runoff reduced to 17.1% in Q2 FY24 from almost about 20% in Q2 of last year. So we had taken certain decisions that we need to get the mix changed on the profile side. So we have been increasing salaried segment. We are going a little slow on self-employed. And in terms of product, we are focusing more on home and slightly less on the non-home piece. And we have completely moved to retail granular business. So if we look at our 1 CR, it is now close to 88% incrementally compared to 85% in Q1. So this is due to our increased focus on lower ticket loans. So I'm not very sure because there was some disturbance. Let me repeat on sanction and logins. I mentioned about the disbursement in Q1 and Q2. We have seen a very good traction on logins and sanctions. On a YOY basis, we have shown a growth of 31%. So we see very good traction. Market is very good. It's quite robust. Demand is robust. And our disbursement guidance and book guidance is on track. We also thought we should do some bit of tweak in terms of geographical concentration. So we have been increasing our share in South. South is a very good market. If you have to look at H1 FY23, the South contributed to almost about 29.5%. And if you see that now, Q2 FY24, it has gone up to 37.5%. So significant increase in contribution from South. If you look at West, West was 36%. And this is by design. We have come down to about 20.5%. North, for us, North includes a couple of locations from East as well, which was 34.64% has now come down to 33.12. So I think broadly North is same, West is slowly coming down, and South is going up. On asset quality, on a YOY, last year Q2 we were at 6.06%. And now we are at 1.78%. That is 427 bips lower. And compared to Q1, we were at 3.76. Now we are at 1.78, which is 197 bips lower. In terms of retail GNPA, compared to last quarter, which was 2.49, now it is 1.74. On a YOY, which was 3.39% last year, Q2, now we're at 1.74, which is 165 bips lower. On the corporate side, last quarter, GNPA was 25%, and now it has come down to 2.86%. So net NPA is now at 1.19% compared to 2.59% last quarter. And a year back, Q2 FY23, it was 3.59%. So there has been a very good traction on corporate with resolution of one large account. And on the retail side also, I think it has been a combination of aggressive cash collection and also we took a one-off call on the retail side, and we also increased the PCR. On the borrowing mix, there has been a very little change compared to last quarter, but however, in next 2 or 3 quarters, there will be slight change. Our bank borrowings, which was 42% last quarter, now it has come down to about 40%, and this might further come down by 1 or 2%. Deposits, it was about 32%, and now it is 31.4. I think it would remain where it is. Maybe it might go up by 1% or 2. NCDs, we are slowly increasing. We are now trying to raise from market in terms of both NCDs and CP. CP, which was 0.7%, now it is 3.3%. So slowly we are increasing. NHB refinance, as of now it is 4.8%, but this will go up since we very shortly will be availing finance from NHB. So on the liability mix, not much of changes, but there will be slight tweak in terms of bank borrowings, NHB, NCD, and CP. On margins, I think we had guided spread of 2.5% and NIM of 3.5%, and this would be maintained. On credit cost, we had guided 0.6% for this year, and from next year onwards, it will be 0.4%. I think we are very much on track. If you look at H1 credit cost, it is 31 bps. Last quarter was 37 bps, and this quarter is 26 bps. CRISIL and ICRA has updated the outlook of PNB HFL to positive from stable in Q2 of FY24. CARE updated the outlook in Q1. I would request Vinay to cover on financials.
Yeah. Hi, good evening, everybody. I will take you through some of the key financial highlights. So as you have seen, PAT, we have reported around 383 crores of PAT in Q2, which has grown 46% year-on-year. For H1, PAT grew by 47% to INR 730 crores. Revenue grew by 6% year-on-year to INR 1780 crores in Q2. However, there was a one-off of INR 160 crores in Q2 FY23 on a signed loan due to benchmark rate reset. Excluding the one-off of last year, revenue grew by 17% year-on-year. Similarly, for H1, revenue has grown 13% to INR 3487 crores. Yield and cost of borrowing is at 10.58% and 7.99% respectively during Q2 FY24, which are maintained at similar levels on a sequential basis. Spread is also maintained at 2.59%. NIM for the quarter is 3.95%, up 9 bps quarter-on-quarter. On year-on-year basis, again, NIM shows a decline by 19 bps due to the one-off that we spoke about in the interest income line last year. Excluding one-off, NIM has actually improved by 83 bps on a year-on-year basis during Q2 FY24. Credit cost for the quarter is 26 bps for Q2 and 31 bps for H1 FY24, which is within our guidance of 0.6% for FY24. We maintain our guidance on the credit cost for full year at 0.6%. ROA, which was at 1.6 for FY23, is 2.14% for H1 FY24. We have also registered an increase in ROA on a sequential basis. ROE for H1 is 11.1%. In Q2, Opex has grown 24% year-on-year, and in H1, Opex has grown 25% year-on-year. This is primarily driven by royalty expenses and investment for affordable business, which was not there in the last year. Capital adequacy is at 30.38% as of 30th September, which includes Tier 1 capital at 28.5%. Handing it over back to Deepika.
Yeah, we can now open the floor for Q&A, please.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Varun from Kotak Securities. Please go ahead.
Hi, sir. I had a question regarding the cost of borrowing. Your cost of borrowing looks to have flattened out, but still there must be some impact left of NCDs repricing, right? Where do you expect this to settle?
NCDs are all fixed rate, so there is no impact left. And again, for MCLR also, most of the repricing has already happened, and hence our cost of funds are flat right now.
I mean to say that as they mature, you need to refinance it, right? You'll be raising NCDs or getting them replaced by other kind of borrowing. So your incremental must be higher than what you have borrowed something like 2 years or 3 years ago.
No, not really. The cost is actually almost same, or in fact slightly lower than what it was like 2-3 years back.
Okay, so this is what you would expect for this full year and going forward, maybe slight benefit, right?
Yes. It should be. It's a regular course of business. We will keep replacing. This should not have any major impact.
Okay, thanks.
Thank you. The next question is from the line of Shubhranshu Mishra from Phillip Capital. Please go ahead.
Hi, thank you for the opportunity. I was just looking at the slide that says 14,000 channel partners. This is for all retail loans. Is that a fair understanding?
Yeah, this is for all the retail loans. Largely on the prime side and deposit agents. Both put together, we have 14,000 partners.
Understood. So that is like entire 100% of your sourcing. If you can spell out what would be the concentration in the channel partners, say top 100 channel partners contribute to what percentage of disbursement versus say top 500 partners contributing to what percentage of distribution at this platform?
No, there is no concentration. We have multiple channels. One is DST, second is DSA, third we have digital, and of course to a small extent we have branch walk-in, which we call as direct. So there is no concentration because if we have to look at the sourcing mix between DST and DSA, DSA is about 40 and DST is 60%. So there is no concentration with respect to sourcing from DSA.
Understood. And in terms of branch concentration, top 10 branches contributing to any particular number of disbursements, we can speak on that. Concentration of.
No, there is no concentration in terms of branches, but of course there are certainly, the top 5 states for us is Maharashtra, this is on a book level, Maharashtra, Delhi, Tamil Nadu, Telangana and Karnataka. And typically if you look at, these 5 states would always be in the top 7 or 8 states for us. So it is, we had changed the strategy and we wanted to get a better share from South, and therefore we were a little bit more focused on South, and that is where we saw that there is a shift in business and there is an increase almost by about 9-10 in the mix from South.
Understood. And if I can just even one last question on this South strategy. Essentially, South, the credit could be slightly superfluous because of the number of organized players, and there could be slightly more salaried versus North India. So then are we necessarily taking the yield compression building into the business problems as well?
I couldn't hear you properly. I think your question was that we are now focusing more on South because we want to increase our salary. I think it is not just South, it is across the country, all geography. We want to change our profile mix. We wanted to increase our sourcing from salaried. And typically South happens to contribute on the higher side, on the salaried side. Otherwise, we are present across the country and our focus remains focus on 22 odd states where we are present.
So then a fair understanding would be that it would lead to yield compression if we focus more on salary.
No, not really, because within salaried, see, one is in terms of profile, we have changed our mix slightly, incrementally, slightly skewed towards salaried. But what we are doing on salaried also, we are now focusing more on the affordable side, affordable income salaried, so that the yields could be higher. So there is no yield compression because of the change in profile mix. Within salaried, we have identified opportunity where we can build the book at a higher yield.
Understood. Thanks. I'll come again with you.
Thank you. The next question is on the line of Renish from ICICI. Please go ahead.
Yeah, hi sir. So two questions from my side. One is on this, excess provision write-back, which we had due to the last corporate account getting resolved. So in P&L, why does it reflect? I mean, the stage 3 provision is also sort of flat, and there is no subsequent increase in the PAT as well. So does it try to assume that we have done a write-off in the retail side?
So on the retail side, we, of course, obviously we got write back, of provision on the corporate account, and that we have utilized, for three purposes. One is ECL true-up on retail corporate, and also we took some one-off on the retail apart from cash collection.
So you mean retail write-off? I mean one-off retail write-off?
Yeah, that's right.
Okay, got it. And secondly, sir, this slightly, from a medium-term strategic point of view, so let's say pre-COVID, our leverage used to be 7-8 times, and we used to generate 14-15% ROE on a 1.5% kind of ROA. Now, given our ROA has improved significantly, and considering our guidance, be it on NIM, be it on credit costs, or be it on the earned growth side, it seems to suggest that current trajectory more or less will sustain. So where does our ROE should settle, maybe in a medium term, considering the past leverage?
See, if we now look at our affordable business, I think incrementally it is contributing to about 9%.
So I had following up from the last participant, your guidance of 17-18% loan growth is on retail, right? Not on.
Yeah, it is on retail. Right. It is on retail, but however, if you look at the corporate book, it is degrowing. So now the book is less than 2,400 crores. So the guidance what we had given was on retail. Yeah, you're right.
That's it. So the other thing is, again, coming back to that write-off that we have done. So it seems like, I mean, excluding this one corporate account that we have resolved, the gross stage 3 has come down by about 400 crores, excluding that corporate account. And out of that, we've taken around 320 crores of write-offs in retail. So if you could just explain this part a little better, that whatever releases we had from the corporate NPA account, almost 200 crores of releases is what I see. How did we because the thing is, one would have thought you will want to increase the provisioning cover on your maybe retail loans, but contrary to that, we've chosen to take a write-off. So if you could just explain the thought process behind that.
So if you look at our overall GNPA last March, it was 8.13. Now last quarter it was 3.76, and this quarter it is 1.78. Right? Now, even if you look at retail, last March was 5.5%, and last quarter was 2.49. So what I'm trying to say is that there has been a consistent decline in the retail GNPA as well, not just the corporate. Now, whatever provision write back we did, we have utilized that for three things. One is ECL true-up, that is PCR, on retail, and ECL on corporate. And we utilized that amount for bit of write-off. So it is combination of all these three.
Got it, sir. And sir, just one clarification here. I'm just referring to note number 4 of the SEBI results release. There it says that from this corporate NPA account which has been resolved, we've recovered 828 crores. Am I reading it right?
Yeah, you're right.
Yeah, that's right.
Got it. And so all of this 828 crores, we've received it in cash. There are no SRs which are involved.
Yeah, it's 100% cash deal.
Got it. So then one last question. Again, when you kind of talk to, senior leaders like you in the industry, somewhere there is an acknowledgement that maybe in mortgages, particularly smaller ticket mortgages, again 15 to maybe 25, 30 lakh kind of a ticket size, there is some slowdown that people are talking about. Are you also seeing that? Because, obviously it doesn't reflect in the disbursement numbers that you've reported, but are you structurally seeing some slowdown in maybe urban affordable or lower ticket affordable housing?
So, if we talk about affordable income base, the competition has increased. But if you talk about overall affordable, which typically all the NBFCs and HFCs focus, I think there is no slowdown. There is no slowdown. As I had mentioned, there are 4 segments: super prime, prime, affordable income, affordable assessment. So if you are talking about, I think, bit of prime on the lower side and affordable income, I think there for some time there was bit of slowdown, but we have not seen any slowdown. For us, we had to correct a lot of things internally, and therefore, we had guided a disbursement growth of 22%, and we have, already shown 18% growth. So in next 2 quarters, we will catch up, and we will be more than 20-23% growth on disbursement. On the book, we had guided 17% to 18%, and in next 2 quarters, we will catch up, and we will be able to show growth of 17-18%. So we have not seen, even if you look at our affordable, even though the size is very small, because we started about 8 months back. If you see, whatever be the size, I think we are seeing significant traction given the number of branches and team size. We've seen significant traction. We've been growing at about 60% quarter on quarter on the affordable. So we have not seen that slowdown. However, even I have read many reports which spoke about bit of slowdown in this segment.
Got it, sir. And so just one last question. My line was a little bad when you were explaining the ROE improvement and consequently ROE also improving as leverage picks up. Is the understanding right that, obviously we have levers on the borrowing cost side? Going forward, there could be potential credit rating upgrades which could feed into an improvement in what the decline in borrowing costs. At the same time, as you keep doing affordable, maybe yields can improve marginally from here, which suggests that margins could remain stable to a minor improvement. But in terms of your guidance of credit costs of 40 basis points for next year, Opex, I don't know how much of a room is there to further optimize Opex. So just trying to understand, what is it that you were telling about ROE expansion from next year onwards, 25 onwards?
In terms of Opex, I think we'll be more or less stable in terms of percentage. We'll be somewhere between 80 to 90 bits. In terms of credit cost, I had guided 40 bits from coming year onward. This is blended. I'm not talking about short term. I think long term. I think 40 bits will be the credit cost, given the blend of prime and affordable. Right, and the mix, as I mentioned, is changing. So incrementally this year, we will probably looks like we will be at about 12% and odd on Roshni out of the overall disbursements what we're going to do this year, and this will keep improving. So I think directionally, I think our effort is to ensure that we identify pockets where we can build book at a much higher yield on the prime side, increase Roshni penetration so that the yields would be higher and which will help us in better profitability. On the Opex side, we'll be able to maintain at the current levels between 0.8 to 0.9. I think on the credit cost, it will be 40 bits from coming year onward. I think this is the overall direction what we want to make.
Got it, sir. This is useful. Thank you so much. Wish you and your team the very best.
Thank you.
Thank you. The next question is from the line of Onkar Gugadare from Shree Investments. Please go ahead.
as the overall NPA have come down drastically, what would be the guidance or trajectory of the NPA in coming 2-3 quarters as well as the next 2 years?
See, I think in next 3 to 4 quarters time, we would want to be one of the best in the housing finance industry on asset quality. This will be a combination of,
Hello?
Hello. Sir, you are not audible.
Hello? Hello?
Yes, ladies and gentlemen, the line for the management seems to have disconnected. Please stay with us while we reconnect with the management. Ladies and gentlemen, we thank you for your patience. We have reconnected with the management. Onkar, I would request you to please repeat your question.
Yeah, I was asking about the NPA trajectory for, say, next 2-3 quarters as well as for next 1-2 years on a gross level.
Yeah, so I think that MD has responded. So that right now is at 1.74. We are trying to bring it down in line with any other, comparable with housing finance company. And we shall be comparable on this parameter in the next 2-3 quarters with any other well-managed housing finance company. Even on the credit cost, we have guided around 0.6 for this year and 0.4% from next year onwards.
This in line with the other NBFCs or best in the class you are talking about?
Yes.
For
yes.
Yeah, for individual as well as for the corporate loan, right?
Yeah, overall, yes, because largely we are now retail, 97% is our retail now. So it's overall.
Okay, just wanted to know what are the cost of funds for this quarter and incremental cost of funds right now?
It's almost same as previous quarter. We have closed this quarter at 7.99%, and incremental also is somewhere in the same range, 7.9%.
Okay, and there were a couple of one-offs in this quarter, say like for pre-provisioning profit and for NIMs and all that. So that would continue for the next quarter as well, or that would be that would normalize in coming quarters?
No, there are no one-offs in this quarter. One-offs were in the last year same quarter. So for a comparable purposes, we have excluded and given a comparison. But this quarter, there are no one-offs. Even on the credit cost side, those one-offs are utilized for enhancing provision on corporate side and taking certain one-offs on the retail side. But other than that, there are no one-offs in the financials in this quarter.
Okay, can you just highlight your guidance on ROA front?
ROA right now is around 2.24 this quarter. It has been improving sequentially. Previous quarter was 2.1 and now we are at 2.24. Our endeavor is to keep improving and keep working on it. I mean, we are not giving guidance on this. We are giving guidance on the spread and NIM, which we are going to maintain.
Okay. And as far as the gearing is concerned, you have already mentioned in the next 2-3 years you will be at 6.5-7%, right?
Yeah, 6 to 6.5 is what we are trying to.
Okay. All right. Thank you.
Thank you. The next question is from the line of Kunal Shah from Citigroup. Please go ahead.
Yeah. Hi. So the question is with respect to yields, given that now the focus is also going to be on the individual as well as home loan portfolio, and given the ticket size of almost like 29 lakhs and 32.5 lakhs in LAP, how do we see the risk in terms of the balance transfer given where we are in terms of the cost of borrowing? And over last 3 odd quarters, how much has been the pricing power with us when we were growing the retail portfolio? How much have we been able to pass on in terms of the lending rates? So if you can just let us know in terms of the incremental lending rates, particularly in this category of ticket size. Yeah.
Runoffs for us have been very stable and consistent. We have been in the range of 16 to 17%. This is total runoff, including the regular EMI payoffs and BPs and foreclosures. The total has been in the range of 16 to 18. It used to be in the range of 20 to 23%. So it has been now in this particular range for last few quarters, and we intend to maintain it. I didn't get your second part of the question. Can you just repeat?
No, I just wanted to check. So could I gauge that it's somewhere around 4.5% run rate for a quarter, which leads to like almost 18% increment and runoff. But just in terms of the risk on the yield side, okay, because this is going to be extremely competitive, and have we seen the pricing power for us, maybe for the industry, if the rates have gone up, to what extent have we also have been able to pass it on over last 3 odd quarters in terms of particularly the home loan portfolios? How much is the lending rate increase that we have taken?
So we have completely passed on the entire increase that we have seen on the repo rate. So that has been completely passed on. Roughly 240 to 50 basis points has been passed on, and this is the rate now on a steady state basis after all the pass ons are done.
Okay, so incremental yields would be how much now on loan and lend?
Incremental
lending, yeah.
9.6 to 9.7.
9.6 to 9.7. Oh, okay. Compared to our book yield of 10.6.
Correct.
Okay. Okay. And lastly, in terms of the breakup, so this 45 crores, if you can just help in terms of how much was the write back, how much was the write off, and there is some increase in the coverage, which you can clearly highlight. Was not able to gauge in terms of how much is the write off and the recovery. Yeah. So 45 crores is the net amount. Yeah.
Yeah. So 200 crore was 199 crore was the write back that we have got on resolution of one corporate account, and the net P&L impact is 45. So you can work out the math for the rest.
Okay, and this entire amount would be write off then largely, or it would be provisioning as well?
It is used for both.
45. Yeah.
It is used for both, for strengthening stage 1 ECL on the corporate and for strengthening ECL on the retail and for certain one-off that we have taken on the retail.
Okay. Okay. Yeah. Thank you.
Thank you. The next question is from the line of Jigar Jani from B&K Securities. Please go ahead.
Yeah, hi. Thanks for taking my question. Sorry to just continue with the previous participant's question. If I look at your presentation in terms of the ECL provisioning, Q on Q, your total ECL provision has dropped from 1485 to 1196. This is despite you taking a 245 crores kind of provisioning, which is the 199 crores right back and the 45 crores to the PNB. So is it fair to understand that the overall write-offs would be somewhere around 400 to 450 crores?
No, it's not.
So can you just explain me the bridge as to why our ECL provision is kind of going down despite having write-backs and provisioning to the PNB?
No, I think that we can take up offline. I mean, that is like a lot of numbers, so we can take it up offline.
Sure. No worries. And just wanted to know what is the incremental yields that we are doing on the affordable housing portfolio on the HL and the LAP side, or we are just doing HL right now?
Overall, as I said, it is between 9.6 to 9.7. On the affordable side, our overall yield is around 11.5%.
And we'll be doing both HL and LAP here, right?
Yeah, both HL and LAP put together.
Okay. Thank you so much for answering the questions.
Thank you. The next question is from the line of Anusha Raheja from Dalal & Broacha. Please go ahead.
Yeah, thanks for taking my question. So you said that on construction finance you would want to, grow this book back again. So if you can just, throw some light in terms of strategy, like how you planning to grow this book, how much of the average ticket size, and what share we can, expect from this book in an overall loan book.
So I think as a mix going forward, when we start doing corporate business, in the overall mix, this will be less than 10% at its peak. So we will restart this business in few quarters from now. And when we restart, we'll be focusing only on construction finance. We'll be pick and choosy on builders and projects and locations.
Hello? Can you hear us? Hello?
Anusha, you are audible. You may proceed.
Anusha, can you hear us? Can you take the next question, Darun?
We will take the next question. Yes, sir. The next question is from the line of Harshvardhan Agrawal from Bandhan Asset Management. Please go ahead.
Hi, sir. Thanks for the opportunity. So just wanted to get some more color on the write-off that you've taken on the retail part. One is if you could share the quantum of the write-off, and secondly, give some more color as to what kind of ticket sizes those loans were. Were they specific to any geography? Were they independent houses or apartments? If you can give some more color around that, please.
The write-offs, as I stated, it was on the P&L side around 200 crore we had, which was available to us. The net P&L is 45, so around 245 crores we have used between write-offs and for strengthening the PCR on stage 1 assets of corporate. So it is basically a combination of these two that where the funds are being utilized. It was largely, doubtful 2, doubtful 3 category of assets.
And so this was like what ticket size of loans that we had written off?
These are normal retail cases, so there is no specific pool as such, but these are normal retail cases which were in NPA in doubtful 1 and 2 category.
Sure. And thanks, sir. And then just one last thing as to, because the guidance that we have given on the asset quality, it tends to increase from further year on. So any such one-off write-offs that we planning in future quarters?
As of now, there is no plan. There is no plan for any one-off in future. We will not be able to comment on that, but definitely, yes, our endeavor is to try and bring down the NPA on retail side as well. I think largely it will be driven by collections and legal.
Sure. Great. Thanks a lot, sir. Thanks for this.
Thank you. We have the next question from the line of Bhuvnesh Garg from Investec Capital. Please go ahead.
Yeah. Thank you for the opportunity, sir. Couple of questions. Firstly, sir, what was our BT out rate for this quarter and for last couple of quarters?
BT out.
Hello.
See, overall, we have given a runoff rate of 16 to 18%. This includes normal runoff as well as BT and foreclosure. It will be somewhere between 7 to 8% only for BT.
And what was it for, say, Q1 and Q4?
Q1 was also, it is in the same range for the last few quarters. It used to be in the range of 9 to 10%. It has come down to the level of 6 to 7% now for the last few quarters.
Got it, sir. Got it. And in terms of growth, sir, if I look at on our slide 6 that we have growth path for retail loan book. So in Q2, I mean, our retail loan book has grown by 1493 crores, similar, slightly lower than what the growth was in Q1. But generally, what we have seen that Q2 is a better quarter than Q1. So what explains this lower growth in retail loan book in Q2?
No, retail has grown better in Q2 than Q1. And if you look at disbursement sequentially also, there has been a good 13.5, 13.6% growth over Q1.
Right. Yeah, but in your slide 6, top left chart, so I see from April to June, 1507 crores, and then from June to July to September, 1493 crores. That's increment in retail loan. Just want to understand this.
Yeah, there is some impact of write-off in that, so hence it is looking lower. But if you see gross disbursement, that has grown 13% quarter on quarter.
Got it. And sir, considering that our total disbursement for H1 has grown at about, I think, 13% YOY, and we are guiding for 22% YOY growth for full year. So what gives you confidence that it will accelerate in H2? So what are the key drivers that you are witnessing?
So I think last 3-4 quarters, as I mentioned earlier, we were really working on trying to change some of this mix, profile mix, product mix, geography mix, moving away from super prime completely and moving to prime and affordable. So we were focusing on all these things, and therefore, it was by design, consciously, we had to grow at this level. And H2 is always better than H1. And within H2, you will see that Q4 would be, really very good compared to Q3, and Q3 will be far better than Q2. And we will cover up in Q3 and Q4. So, which is what I mentioned earlier as well, 17 to 18% of book growth and 22-23% of disbursement growth is well inside.
Got it, sir. Got it. That's it from my side, and thank you for the answers. Have a good day. Thank you.
Thank you. The next question is from the line of Ravi Naredi from Naredi Investment. Please go ahead.
Hello. Thank you. So my question is regarding your comment in press release that 160 crore one-off in Q2 financial year 23. So exclude this NII growth 35% year on year. So please elaborate this 160 crore one-off income. It's a comment not in last year Q2 result also. So
see, as I said, so whenever there is a benchmark rate reset, even on the securitized book, you have to change the rates for that book, and you have to take an upfront gain. So that upfront gain came as a one-off in Q2 last year when we changed our rate resets by around 100 basis points. So it was one-time gain that came last year, which is not there in the current quarter. So hence it has been called out separately.
Okay. And the next question is regarding the COVID-19 related stress asset. So rupees 1600 crore of. So what is the average tenure of these exposure? And what is your assessment related to this exposure?
So I think you're referring to restructured pool. So the tenor is on par with the entire portfolio tenor, so there is no difference. But for the only change that during the restructuring period, some of these customers would have opted for interest morat, which could be for maybe ranging from 3 months to 12 months or maybe 15 months. So otherwise, the tenor is broadly in line with the entire portfolio, retail portfolio.
Okay. Thank you, sir.
Thank you. The next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yeah, thank you for allowing me a follow-up. Just one question. Recently, you were in your opening remarks talking about restarting construction finance in a couple of quarters. You'd also mentioned the ticket size that you're looking for. Can you just elaborate on that? What ticket sizes are you looking for in construction?
So we are still working on that, but there is a plan to start corporate business very shortly. Could be 2-3 quarters from now. So when we restart, we'll be really pick and choosy. We will do corporate business more from a strategic point of view, which could enable our retail growth. Ticket size would be about 150 to 200 crores. That is what we would be looking at. And we'll be very pick and choosy on the developer projects, and we'll do in select locations.
Got it, sir. And so typically these projects that you're planning to do, I mean, I understand, maybe 2-3 quarters away and too early to comment, given that maybe you've not started working on this piece yet, but broadly, will the yields in the corporate book that you will be building be lower than the yields that we have in retail today?
Not at all. I think the yield on corporate will be much higher than the retail book. But yes, I know since we are going to focus on select developers, good developers, the yield may not be significantly higher than the prime yield. But definitely, if you compare to, let's say, our affordable business, Roshni, it will be on par or maybe slightly less than that. Because today, Roshni, our yield is about 11.5%. I think this would increase over a period of time, and this could go beyond 12%. So even the corporate book yield, would be on similar lines.
Got it, sir. That's all from me, sir. Thank you so much.
Yeah.
Thank you. We have the next question from the line of Varun from Kotak Securities. Please go ahead.
Hi, sir. Thanks for giving me the opportunity again. So if I look at the restructured book, that was about 1,700 crores, and there's some movement of that into NPAs and some of it has been written off. But there's still some 1,500 crores in the standard book. So is this coming out of resolution, or all of it moved out of moratorium? Where are they right now in stages, and what's the provision on?
So as of now, there is nothing in the restructured window. So all the cases which are restructured, EMIs have fallen due and they are servicing. So whatever we see today in various stages, stage 1, stage 2, stage 3, is post the completion of restructured period.
And are there any additional provisions on this restructure, or as per ECL model, that's what you've provided?
There is nothing additional.
As per ECL model, the provisioning is done. Yeah.
Varun, does that answer your question?
Yeah.
Thank you. We have the next question from the line of Onkar Gogardare from Shree Investments. Please go ahead.
Yeah, you were talking about overall loan book growth of 17-18%. That was only for retail category or overall loan book you were talking?
Retail category, because corporate we are degrowing, and by the time we start, it will take another 2 to 3 quarters. So the growth, what we were talking was only on retail.
And what about the overall growth then?
I think more or less it will be in line, because today if you see out of overall portfolio, retail is about 97%, and even if you see what the book was last year, I think the gap is going to be about maybe 3.5%. Otherwise, largely the growth is going to come from retail till we start corporate.
So overall growth would be similar to the retail only.
17 to 18% what I mentioned was on retail.
Yeah, correct. But once you start growing the construction finance, what can happen?
No, construction finance, it will be a very small business for us. At its peak, it will be less than 10% of the entire portfolio.
Okay, and right now the retail is consisting around 97% of the overall loan book.
Yeah.
Okay, all right.
We have no further questions, ladies and gentlemen. I would now like to hand this over to the management for closing comments. Over to you, sir.
Thank you. Thank you everyone for joining us on the call. If you have any questions unanswered, please feel free to get in touch with Investor Relations. The transcript and audio of this call will be uploaded on our website. Thank you.
Thank you. On behalf of PNB Finance Limited, that concludes this conference. Thank you all for joining us. You may now disconnect your lines.